Domestically, water supply interruptions, especially in coastal towns, and animal disease outbreaks, as well as slow development budget execution, may continue to pose downside risks to growth. Annual inflation averaged 3.6% during the first 5 months of 2025, lower compared to the 4.9% during the same period in 2024. The deceleration was primarily observed in the housing, transport, and alcoholic beverages categories. Additionally, inflation fractionally edged down to 3.5% in May 2025 from 3.6% in the preceding month, mainly on account of slower inflation in housing, augmented by the deflation in transport. For 2025 and 2026, inflation projections have been adjusted downwards to 3.9% and 4.3% respectively. That is 0.3 percentage point and 0.2 percentage point lower than the previous forecast. The revision for 2025 primarily reflects the smaller than anticipated increment in administered prices and a stronger exchange rate. The annual growth in PSC has ticked up since the previous MPC meeting, registering 4.5% in April 2025 relative to 3.9% in February 2025. Similarly, growth in PSC increased on average to 4.4% during the first 4 months of 2025 compared to 1.7% in the same period in 2024. These increases were reflected in credit extended to both businesses and households. Despite trending above inflation for the past 7 consecutive months, PSC growth remains sluggish. Namibia's merchandise trade deficit narrowed by 19.8% to 11.4 billion Namibian dollars during the first 5 months of 2025 compared to the same period in 2024. This improved position was attributed to a faster increase in export receipts, notably from uranium and gold, relative to the rise in import payments. The stock of international reserves stood at 57.4 billion Namibian dollars as at the end of May 2025, dropping from 59.7 billion Namibian dollars recorded at the end of March 2025. The decline was mainly due to trade-related outflows, customer foreign currency withdrawals, and revaluation losses. This level of foreign reserves translates to an estimated import cover of 3.7 months, which is deemed adequate to stay in the currency peg between the Namibia dollar and the South African rand and meet the country's international financial obligations. Let's turn to the global picture. The global economy maintained a moderate pace of growth in the first quarter of 2025, with the medium-term outlook remaining under significant downward pressure. Since the previous MPC meeting, global inflation generally slowed, while key stock and bond markets remained relatively volatile. Monetary policy stances eased across most of the monitored central banks. Global growth was steady during the first quarter of 2025 relative to the fourth quarter of 2024, with divergences between individual countries having been noted. Among the monitored economies, growth slowed in the United States, United Kingdom, Brazil, and Russia. Growth remained weak in South Africa and steady in China, whereas it picked up in the Euro area, Japan, and India. Global growth prospects have deteriorated since the previous MPC meeting, with the International Monetary Fund, IMF, now projecting world output growth to slow from an estimated 3.3% in 2024 to 2.8% in 2025 and 3% in 2026. Prices for most key international commodities increased since the last MPC meeting. The price of gold has continued to rally, reaching a new all-time high most recently, buoyed by safe haven demand. Crude oil futures prices have increased, mainly ascribed to the recent escalation of geopolitical conflict in the Middle East. Turning to base metals, copper futures were higher primarily due to supply disruptions, while zinc futures marginally ticked up due to tighter supply. Moreover, uranium spot prices also edged higher, supported by improved risk appetite and positive investor sentiment regarding the growing number of nuclear reactors. Diamond prices remain subdued, attributed to weaker global demand and competition from lab-grown diamonds. Since the previous MPC meeting, global stock markets initially sold off in early April 2025 before recovering subsequently. These developments largely reflected the US's announcement of reciprocal tariffs and its subsequent 90-day suspension. Pivoting to key bond markets, yields mostly fluctuated sideways, but have returned to levels observed at the previous MPC meeting, although with a downward bias in the case of South Africa. Global inflation has generally receded since the April MPC meeting, despite some cost pressures from rising tariffs. Among the monitored advanced economies, inflation moderated in the Euro area and Japan, edged up in the United Kingdom, and remained stable in the United States. Furthermore, inflation slowed in most of the key emerging market and developing economies. Meanwhile, deflationary pressures persisted in China. Going forward, the IMF projects global inflation to decline from 5.7% in 2024 to 4.3% in 2025 and 3.6% in 2026. Inflation is now projected to come down at a slower pace than previously anticipated, mainly due to the potential impact of trade tariffs and the ongoing conflict in the Middle East. Since the last MPC meeting, most of the monitored central banks have reduced their policy rates, marking a deviation from the previously unchanged monetary policy stances. In the key advanced economies, the Bank of England and the European Central Bank reduced rates, while the US Federal Reserve and the Bank of Japan maintained rates steady. Among the emerging markets and developing economies, most central banks lowered their policy rates, except the Bank of Brazil, which continued to tighten. So given this background, what's the monetary policy stance that's appropriate for the next 2 months? Against this background, the MPC decided unanimously to keep the repo rate unchanged at 6.75%, a full percentage point decrease compared to a year ago. Commercial banks are accordingly expected to maintain their prime lending rates at 10.5%. This policy stance will continue safeguarding the one-to-one link between the Namibia dollar and the South African rand while supporting domestic economic activity. While the MPC has decided to maintain the repo rate at its current level, it has been discussed and observed that within the countries of the Common Monetary Area, the CMA, the long-standing practice has been that the prime rate does not exceed 3.5 percentage points above the repo rate, only with the exception of Namibia, that has maintained margins of 3.75 percentage points. In this regard, the MPC is urging the commercial banks to heed the call of the bank to start aligning their margins above the repo rate to the levels of other CMA countries. This move will address this anomaly and in time provide relief to consumers. Given the adjustment that is required on the operating models, the commercial banks will be given a specified time frame to align accordingly. In considering the appropriate policy stance, the MPC was wary of the prevailing uncertainty from fundamental global economic and trade policy shifts. Furthermore, the escalating Middle East conflict and its potential ramifications for global inflation and growth could not be overlooked. It was evident that these evolving developments were gradually working to suppress the monetary policy space that would have otherwise been directed to support economic activity. This stance is also a step towards reducing the interest rate differential between Namibia and South Africa in the interest of orderly capital flows.